Hi everyone, welcome back to the channel. This video is a part of the monthly portfolio update series made for the individuals invested with me on Etoro. During June, the portfolio was down 6.57%, and for the year, we're down 5.75%. We are invested in KWeb, Alibaba, Warner Bros. Discovery, Paramount, Cardlytics, Tencent, and VF Corp. This month, we got some huge, unexpected news about Paramount. On 7 July, Paramount and Skydance announced that the companies had come to an agreement to merge. According to the press release, Paramount Class A shareholders would receive $23 per share and Class B shareholders would receive $15 per share, for a total consideration of $4.5 billion. The second step of this deal would involve Skydance merging with Paramount in an all-stock transaction valuing Skydance at $4.75 billion. Skydance shareholders would receive 317 million Class B shares valued at $15 per share. The Skydance Group would provide an additional $1.5 billion to improve Paramount's balance sheet. The most interesting part of this deal is the 45-day go-shop period. This period would allow the company to actively solicit and evaluate alternative proposals. There's a very slim chance that we have another bidder here, but there's still a possibility of Paramount shareholders getting a better deal. The go-shop period will end on August 21st. So, in essence, this deal is quite awful for the Class B shareholders. It's only the Class A shareholders that actually receive favorable terms, while Class B shareholders basically receive significant dilution, which would negate any benefits that may come from this deal. This is the reality, no matter how they try to portray or position this to shareholders. There are so many twists and turns that we, as Paramount shareholders, have faced. The only silver lining, if there is one, is that we would no longer be dealing with Shari Redstone as the controlling shareholder if this awful Skydance deal goes ahead as planned. Going back to the portfolio, one of our companies is actually engaging in some fantastic deal making. VF Corp. VF Corp announced on 17 July that they would be selling off the Supreme brand to Luxottica for $1.5 billion in cash. This cash would offset near-term solvency concerns and be used to pay off debt, which would be the right capital allocation decision by management. The new CEO, Bracken Darrell, he has a track record of executing turnarounds, and that is exactly what he's doing here. Downsizing the business, refocusing on the core brands to drive growth with a focus on cash flows. This is a classic turnaround situation with high uncertainty and relatively low risk, where we're betting on the jockey, Bracken Darrell. VF Corp is definitely not a great business, but it's gone from being a dirt cheap opportunity to a cheap opportunity. And that discrepancy between dirt cheap and cheap is where we're able to generate some returns. I'd been tracking this company since October 2023. And over the past few months, the CEO had very clearly mentioned that a brand sale was incoming during the last session's Q&A. He personally has bought $2 million worth of stock this year. All signs point to the turnaround being on track. The next step would be to sell off their Eastpak, Jansport, and Kipling brands and bring back growth to Vans and North Face. I will likely not trim our position anytime soon, even if the stock price does increase a lot from current levels. I like the strategic plan put forth by management, and next year is going to be a year of growth compared to this year where the management was just busy plugging holes on a sinking ship. This struggle has been prevalent right across our portfolio. Over the last 6 months, it's been quite challenging for the companies that we're invested in. China Tech, which is the majority of our portfolio, is recovering slowly despite fundamentals improving. Our primary detractors so far this year have been Paramount and Warner Bros. Discovery, legacy media companies saddled with large amounts of debt. The market does not like these companies because of their debt and the declining legacy business models. But I think that over the long term, the market will be proved extremely wrong about these companies. From my perspective, their debt is an asset due to the structure of the debt. The fact is that both these companies have issued debt when rates were much lower, and almost all of it is fixed rate debt. Long-term fixed rate debt trades at a discount as interest rates rise, thereby giving these companies a sort of discount on their debt. This is evident to anyone who understands bonds and the impact of rising interest rates on bond prices with respect to duration and maturity. I'm not sure when the market will realize the value creation due to the structure of this debt, but I'm extremely certain that we are not going back to sub 1% interest rates anytime soon. As long as these companies are able to sell off certain assets and generate enough cash to pay down debt, they will work out over the next 3 to 5 years. And I hope that over the next 6 months, the true value of the companies that we're invested in starts to come to fruition, because the entire portfolio is trading far below fair value, in my opinion. It has been difficult, but there are some bright spots that have started emerging. That is all I'll be covering in this update. If you have any thoughts or questions about individual positions, please leave a comment on this video, or you could message me directly on Twitter or on Instagram through the links in the description. Thanks for watching this update. Take care.